Hello everyone, this is Jose here, ready to start the session. We're going to start in just a few seconds, but before we start, I'd like to have a sound check, sound test. Could you please confirm on the comments box that you hear my voice? Okay, everyone, it seems that it's time to get started. So I will maximize the introduction slide so we are ready to begin. It seems that you guys also hear the sound correctly, so it's all good. Obviously today I will be expecting less attendees in the session given the fact that is July 4th. And by the way, obviously, super big congratulations message, and I'm sure a great celebration if you are in the USA, since it's such an important date. So congratulations again for the special date. But anyway, today is a little bit of a special day precisely because it's a special date. We will not be executing trades in the markets today, given the fact that it's July 4th. But these also give us the opportunity to do let's call it a special sharpening session, if you wish, because we will not be able to execute today, but tomorrow we will. So this gives us the opportunity to talk about trading, get deeper into certain things, but also plan a few trades to be executed into the following day, which is tomorrow. Okay, so special day today, and I'm sure we're gonna be a reduced group. So please make sure you are interacting, asking your questions, etc. Okay, and in the meantime, I can see Orlando doing a little bit of multitasking here with shorting the Nasdaq. And I would say that based on the smiley face, it's going well. Love it, my friend. Love it. Always trading, isn't it? Anyway, so let's begin the day, guys. Okay, official beginning of the session. My name is Jose Blasco. I will be your guide in today's session. Today it's 4th of July 2019. We are getting together for longer term purposes. So we'll be talking about trades that are trades to be held beyond one day. So anything above and beyond intraday trading will be discussed today. And as I said, since it's 4th of July, the session will be trading, obviously preparing trades for tomorrow, but also a little more in the preparation sharpening side, if you wish as well. Okay, so super happy today. If you want to ask questions about anything, if you want me to go deeper into anything, I'm not in a rush today to execute trades, so we can talk about anything you need, guys. Okay, before we start, definitely disclaimer, let's go for it. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And that would be the end of the disclaimer, which gets us ready to begin the session with TradeStation. So here is the platform. Let me close the PowerPoint presentation as well. So we have less stuff and let's begin. Okay, so what do we have here? So we have our workspace for the days like today when we look at longer term trades. And as you can see on the upper left, I'm still running the scan. I have tweaked a few of the parameters because I was not finding many opportunities. Okay, so I tweaked a few of the parameters to see if I can find a few more opportunities. Okay, sometimes it's the case where certain volatilities get crushed, and especially in the non-directional arena. Okay, so if I show you the VIX, okay, that represents the average implied volatility of the 500 stocks that make up for the S&P 500. You will see as the chart loads that really the VIX is very low, and therefore when running the scan, I had trouble to find stocks with higher volatility. Okay, so it's not going to be many stocks with high volatility, which is also kind of common when we are dealing with when we are dealing with market holidays, especially when those market holidays fall into Thursdays, many people have been, Thursdays or Fridays, many people have been selling options intensively to take advantage of the weekend decay. And because of that, normally in those days, right before those holidays, you find that options have less premium built in. The reason why they have less premium built in is because many people are selling them. And if many people sell, then like everything in life, prices go down. So the options are underpriced instead of overpriced, which is what the scanner is looking for. And therefore, a little bit of a struggle to find opportunities today, okay? Let me see. Great Jose, much appreciated being here with you and all UFO traders. Yes, my pleasure. Yeah, and basically the tweaks in order to get a few more opportunities, I was being a little more flexible with liquidity parameters. So I lowered the volume and I also lowered the open interest in an attempt to be able to see more opportunities, and then I would judge if I wanted to take those trades or not based on looking at the option chain. Okay, so my technicals are gonna be the same, because if I change the technicals of the scan, then I am, instead of stacking odds in my favor, I'm doing the opposite. Okay, so this is not what I was looking for. What I'm looking for is to stack odds in my favor. But when it comes to liquidity, it may be okay to reduce your parameters. By default, the scan, let me write it down so it's a little more visual for you guys. By default, the scan is looking for is looking at volumes that are greater or equal than 500,000 shares per day. And when it comes to open interest for the options, okay, open. So maybe I should write options, open interest. So we are looking at the scan by default. The way it was set up was 100,000 contracts minimum. These were the particular parameters. So now again, the ultimate test for open interest and volume beyond what the scan looks for is basically looking at the option chain. Okay, so let me load an option chain. Again, it's not like I'm too happy to make those volume or open interest values to be lower. But at the same time, it's not like I'm doing something wrong, because yes, in one hand, I will be spotting stocks which are by default less liquid. But in the end, when I plan the trade, I will assess everything on the option chain. So I will get to see the real nature of that stock. Okay, so here's the option chain, so the option station pro. Okay, so then in the end here, you can see the real values. Sometimes you may find stocks that are not so amazingly liquid, but market makers are really interested in bringing more options trading in, or more shares of trading in, and therefore what they do is that they reduce the spreads. So you may trade stocks with a narrow spread, or options with a narrow spread, even though that stock is not so liquid. It just happens to be that market makers are really willing to motivate traders to trade those stocks. Okay, so it's okay to be less rigid when the volume and open interest parameters on the scanner, given the fact that in the end you will have a look at the option chain. Okay, so that's what I was doing, and I'm not sure that these will help either. And by the way, for whatever reason, it's taking very long to calculate that scan. So I will just wait. But in any case, what I was saying is that it's not that big as a problem to become flexible with volume and open interest. Okay. Now, when it comes to the other technicals, okay, if you think about the scanner was looking at specific values for ADX, or DMI, or the moving average and price above or below the moving average, so all those technicals, you cannot tweak that. Okay, so Lisa, super good question, very good question. Okay, you cannot tweak that. Okay, because if you were to tweak that, then basically you are removing odds in your favor by, now maybe going long stocks that are in a downtrend or so on. Okay. Yeah, it may be the case. Lisa, do you guys also have problems? I would love to know if it's only on my side. Maybe it's just a matter of resetting TradeStation or rebooting my computer, something like that, which sometimes may happen with Windows programs, or is it, as you said, probably TradeStation is doing maintenance or something like that. So if it's running slow on your side as well, I would really like to know. It will make me feel a little better, because this is really a little strange, okay? But anyway, I'm gonna keep going, because I told you today I wanted to go a little. You just started the scan, very good. So you let me know, Lisa, please. Thank you so much. So I was saying that today it's a little bit like a mix between a trading day and a sharpening day, okay? And so and therefore, yeah. Yours just finished, okay? Did you get symbols, Bojan, for the non-directional, for example, which is the one I was running now? Did you get symbols, or you got an empty result? Because that's what I got earlier. I got an empty result. So let me know when you can, okay? And so what I was saying is that today I wanted to conduct a little bit of a mix sessions between sharpening and trading, okay? A little bit of a mix, since today we are not in a rush because the market is closed. And in this sense, I have been looking at formally in the sharpening options sessions that we did. We have been looking at credit spreads, okay? So let me write it down. So we learn how to build credit spreads, okay? But when it comes to building other more advanced trades, which I do use in the sessions, such as iron condors, okay? So when it comes to iron condors, we never had a proper session to talk about it. And the fact is that we did say that iron condors is a combination of two credit spreads. So if you take a bear call spread, which is made of buying a call above and selling a call below, and then below the bear call spread, you were to sell a bull put spread, which is selling a put above and buying a put below. And so basically you got two credit spreads. One is the bearish credit spread, the other one is the bullish credit spread. And what happens if you do them together at the same time, where now you just have an iron condor, and basically what you're expecting is the stock to stay in between, and as long as the stock stays in between, then you're fine, okay? Because the strike above will expire out of the money, and the strike below will also expire out of the money as long as the stock remains in between. Therefore, in the upper part, the options you sold will become 0, and in the bottom part, the options you sold will become 0, because they will be out of the money both on expiration as long as the stock remains range bound. So that's an iron condor, which we never had a proper session on iron condors, because in the end, an iron condor is nothing more, nothing else than selling a bear call spread together with selling a bull put spread. Okay, you can choose to look at it this way, and it's quite easy to understand. And therefore, if you have red UFOs above, isn't it? So you have red UFOs above, and that's why you expect the price to get there. Okay, especially if the UFOs are somewhere in the middle part of the range, they will create multiple bounces. And then if below you have green UFOs, okay, so it's the same story. So if you have green UFOs below, this will be likely to produce bounces, and therefore price remain range bound, okay? And you can see what a beautiful artistic drawing I have just put on the screen. I'm just wondering if I should sign, or is no need for me to sign, because this is a masterpiece, isn't it? Anyway, a very bad joke. So let's keep going. So I was saying that we never had a proper session on iron condors, because somehow it's not too needed, because it's two credit spreads. But at the same time, today I would like to go a little deeper into understanding what may be possible when it comes to those iron condors, because there are certain analytic tools that are available in OptionStation Pro. I think it was 2 weeks ago we had a sharpening session to talk about OptionStation Pro. So hopefully now you are more comfortable with this tool. But there are still a few things that we can do, especially by playing with this upper part when it comes to dates and standard deviations and things like that. So we can certainly plan or play with all those parameters to end up with even better trades when it comes to non-directional trades, relying obviously on those UFOs, but also relying on probabilities that are calculated for us automatically from Observation Pro. Okay, so I would like today to look for non-directional opportunities, and hopefully we'll find good trades to be executed tomorrow. But I would like to also take advantage of today to have this mix sharpening session where I give you a little extra insight into probabilities, price movement, speed of movement, standard deviations, all those different factors that will help us to stack a little more odds in our favor, and every bit counts. Okay, every bit counts. Anyway, so what do we have? Bojan, you got symbols. Lisa, you got one symbol only, which is UNH. Royce, you have a few. Okay. Lisa used a non-directional credit scan. Yeah, I'm going to show you the parameters in just a second. I just need to wait until it finishes because the customize button is grayed out. So I cannot show you at this moment, Royce, but I will, okay? Very good. Appreciate your humor, Al. Anyway, that was a terrible drawing. Oh my God. Anyway, funny. So let's continue. So let's go ahead. I'm gonna load UNH since it seems that UNH was in the list. Also, I want to bring briefing.com into the screen because as you probably remember, we said that many times. When options are highly priced, normally there is a reason for that. You could find yourself 18. So July 18 allow us to use the next expiration date. I'm not talking about tomorrow, which is July 5. I'm talking about the next Friday, which is July 12. So if we were to have a proper setup on the chart based on UFOs, well, given the fact that UNH was in the non-directional section of our scan, it would be perfect. Okay, but again, this is what we always do. What I would like to do today is to take this a little bit more advanced and use Observation Pro in a little bit of a smarter manner in order to understand if we do have a trade which is of a very high probability or the trade is not so high probability. Okay, because again, you have heard me say that many times. And what I'm about to say is stocks are fragile. Okay, you have heard me say that many times, and it's so true. We always need to keep that in mind and look for ways to protect ourselves because stocks are fragile, and fragile means that they depend on what the broad market does, right? So the fact that we have UFOs is certainly extremely useful, but that may not be enough because if, let's say for instance, there is no green UFOs at all in the broad market or there is no red UFOs at all in the broad market, well, the red or the green UFOs available on the stock may not work well because the broad market keeps pushing and the broad market obviously drags all stocks together. So it's always certainly very important. Okay, so I just got the scan complete, its process, and I came up with a few symbols here. It seems that Royce, I got more or less the same symbols as you, so which is good. As well, you guys were asking about the parameters, so let me show you the parameters. Okay, so the parameters are price at least $50 per share, the volume average for the last 3 months at least 500,000 shares, open interest at least 100,000. You want to pick the 50 options with the greatest premium, the top 50. Then you wanted the implied volatility to be greater than the historic volatility. And then you wanted the DMI to be less than 25 for the daily time frame. But you also want the DMI to be less than 25 for also the 60-minute time frame. Okay? So in other words, looking at quiet stocks with high level of premium, okay, and this is what we have here, okay? Now, the only problem I have when I look at the screen is when I see that number 40, obviously that doesn't make me happy at all, okay? So I want to check changing sessions to pre and post market to see if I get a much better number, okay? And the number I get here is 44%, which tells us something very important for us to know, which is you should not trade UNH attempting to be too precise with your turning points and your timing. You just cannot. And the reason why you cannot, some stocks are possible, some stocks are not. The reason why you cannot is because it seems that the way the large market participants are trading that stock is that they place their orders in the market, but if they don't get filled, they cancel them. Okay. Other stocks are not like that. For example, if I show you Apple, just to pick one, so Apple is giving you 53%. Okay. If I show you Facebook, Facebook is giving you, what is Facebook giving you? Is giving you what is loading pending data. So we'll see that in just a sec. Okay, just one sec until the data is downloaded and we'll have the whole thing. But certainly it's going to be 50 plus, certainly not 40 plus like UNH. So this is always something that makes me quite uncomfortable. Okay, when I see a stock that is a very low probability, and my default action is just go for another symbol, not to force a trade. Okay, and I recommend you to do the same. Different story, and I want to also show you a time where it may be okay to plan on a trade even though the probability shows as very low. Okay, I would say that certainly TradeStation is doing some maintenance or something, because the speed of download of data is really very, very slow. So I guess that they're probably taking advantage of 4th of July to do some maintenance work. But anyway, so let me show you before I continue planning this trade. So I'm back to the daily time frame. This is Facebook. Let's say for example you have done, which I have it empty right now I believe, but let's say you have run an investor filter looking for wealth opportunities using a weekly time frame, and if you remember when we covered that in the sharpening sessions, we were looking at fundamentals such as PEG, we were looking at dividends. So let's say you put this filter in place and you have UNH, and then you look at UNH and it's not looking too good in the sense that it's 44%, but you know that behind the scenes, even though the large market participants that trade UNH, those guys tend to cancel their orders, but at the same time, you know, you have good fundamentals, you have a good trend, you have, you know, good dividends, you have all those good things. So then it's okay to be a little more flexible with the timing, and be happy or be okay with, you know, acquiring a stock and have the stock move around or move against you for a while. It's okay, because you have this investor mindset and you have other benefits kicking in, such as dividends, for example, while you enter the trade. So then for scenarios like that, UNH, that would be, if UNH was in my scanner in the investor section, I would be okay, and still I would not just go ahead and buy the stock. You know, I would use an options play. Okay, I will use an options play. So what I would do is that, let's say this is UNH, which is not, this is Facebook, okay? But let's say that's UNH, and this is the current price, you know, 197. Oh, you know what, let's move to UNH, since I'm talking about UNH, I think it's gonna be more realistic. So here's UNH, okay? And so the current price for UNH is 245, okay? And you know, this stock is in an uptrend and blah, blah, blah. And let's say, most importantly, you have the good dividends, you have the good fundamentals, because again, in this case, I'm using an investor mindset, right? And you load this chart, and you also look at the weekly time frame. And on the weekly time frame, you see that around 200, okay, you have this very, very, very good, you know, green UFO, right? And when you look at the daily time frame, just a little below 200, 193, but you also have another UFO. So there is a lot of potential for on-field orders at those levels, just a little below 200. So maybe something that you consider doing is, okay, you know what? I'm just gonna sell. Okay, I'm just gonna sell a few 200 puts. Okay, and that will give me premium. Okay, so what do you do with the premium you collected? Well, then you turn around, okay, and you buy calls. Okay, with the premium you collected, you go ahead and buy calls with the premium that you collected from selling the puts. So what does that do to you? Well, what this does to you is that if UNH starts going up, okay, starts going up, you profit. Okay, now you don't get paid dividends or anything because you didn't buy the stock. You sold puts and you bought calls. But because it went up, you profit, because when it goes up, the puts will make money, the call will make money, so you profit. So it's good. Okay, now what if UNH, instead of going up, drops all the way to 200? Well, now it's going to be put to you. And put to you means that now you will be purchasing shares. But instead of purchasing shares at the current price, which is 245, you would be delivered that stock, which is a stock with good fundamentals, etc., etc. You would be delivered that stock at 200, right? And now you start collecting dividends, and basically you have all this room from 200 to 245 in this case, which is the room that allows you to not to be too precise with your timing, okay? And that's how I would do it, okay? So stocks that give me low probabilities when I turn on the UFOs, I mean, it's a very important information to know. It means institutions are canceling the orders. Okay, so when you see low probability, you should be happy because now you know more about how the large players in this market are dealing with the stock. So now that you know that, definitely you need to switch your mode to not using that stock for short term and using that stock for a longer term, and use option strategies such as what I just demonstrated for you guys to be able to mitigate the lack of precision with the timing that you will have, because that's how this stock works. Is that making sense? Yeah, Lisa, the minimum is above 50. Okay, below 50 you have no edge. Above 50 you have some edge, and the higher the better, of course. Now we cannot fall into utopia. The market is made of millions of very smart people buying and selling from and to each other. And you know, those millions of people, many of them are very large market participants and definitely very smart people. So we cannot expect you know, that number to be like 95%, 85%. It's just not going to happen. Okay, so anything above 50 is good. Of course, when you deal with 24-hour markets such as Forex and futures, you'll be above 60s. Okay, sometimes even 70s. When you deal with stocks, which is a market that only trades 6.5 hours a day, that opens the door for more cancellation of orders, and therefore you will be in lower figures. Okay, but never be below 50, because if you start with below 50, then you start at a disadvantage instead of an advantage. Okay, so again, always stacking odds in our favor. Okay, so going back to here, let's look at MMM. Let's see if maybe MMM will give us an opportunity here. So I will switch to 55 a minute time frame, and also I am going to check briefing.com for MMM. Hopefully we'll be good with that because we don't have too many to pick. So I'm just crossing fingers here a little bit. Yes, and we're good. We got July 25. So July 25 means that we could plan our own condors using next Friday, which is 12, but we can also use the Friday after, which is 19. Okay, so we have an opportunity to use 1 week, 2 weeks expiration. Okay, so with pre and post market data, we got 48%. So again, not delighted. I mean, that one, if you were to take it, I'm not gonna say it's crazy because we are really close to 50, but again, not so happy. So what about regular session? Regular session gives you about the same. So I'm not so happy. Okay, I'm not so happy. But in this case, you know, if you tell me, Jose, let's do an exception, I would say it makes a lot of sense because, for example, look at how many red UFOs we have above and look at how many green UFOs we have below. So yeah, that per UFO, you only have 48, we are below 50, but because you have so many UFOs above and below, well, certainly those UFOs should slow down the price movement of that particular stock. And therefore, I'm gonna say, okay, let's go for it, okay? Sometimes you'll see me be a little more flexible. With non-directional trades, it's difficult to draw a line on the sand. And you know, if you have been attending and participating of those sessions, you know, I'm sure that you have noticed that I am all about rules, and it's all about being objective and all about being mechanical, and certainly we can just make it a rule. If it's not 50%, forget about it. But what's the reality? The reality of non-directional trades is that by definition, non-directional trades are trades where you are allowing yourself room for movement because it's non-directional. Okay, so I'm okay to being a little flexible, especially in a setup where I have so many UFOs on top of each other. Okay, and then later on top of that, I'm going to use the probability engine of Option Station Pro to see if in the end we have a trade or we don't have a trade. Okay, so just keep that in mind, that as an options trader, your mindset is like you have a switch, which is when you are directional, you have to be impeccable with precision, and I will never take MMM directionally speaking because it's below 50. But for non-directional, then I will open the door earlier with UNH. We had 40%, So yeah, 40%, it's too low, okay? But 48.6, we're basically very close to the 50, so I'll take it, okay? Cal Gorder, why 55? Well, because we're using edge timeframes. Okay, so we are using edge timeframes, and if you are not familiar with the concept of edge timeframes, I would recommend you to watch on our YouTube channel. Let me show it to you, because this will be eye-opener if you are not familiar with it. So I'm looking at youtube.com/c/tradewithufo. This is our YouTube channel. Most of you, I believe, you would be familiar with this. When you click in Get Together, you look at the playlist for Get Together. And here you would see that we got a whole collection, okay, of videos. It's 85 videos that you have in here. And if you were to look at the ones that were tagged as sharpening for intraday, there are 4. So this is sharpening intraday number 4. Okay, we have sharpening intraday number 3. We have number 2. And right below my screen is also number 1. Okay, so 4 videos. Okay, so if you were to watch the first and the second one, that will give you a lot of explanations of what we mean by edge timeframes, okay? But basically, edge timeframes are timeframes that give you an edge. That's what it is. That's what we call edge timeframes. And basically, we want to use the same timeframes that computers use, because nowadays markets are managed by computers, and you know, that's where you find the orders, and therefore we use the same type of timeframes, okay? Which happens to be Fibonacci numbers, okay? By the way, since we are looking at YouTube, please go ahead, if you haven't, click subscribe and click on the bell, so that way we are better connected, guys, okay? So don't forget to do that. So anyway, so let's plan on the trade, okay? So here we got a scenario where if that particular stock was to go up, it's likely to hit one of those UFOs and go back down. If it goes back down, one of those green is likely to bring it back up, and then it maybe come here and then bring back down, and then, you know, and basically for a while stay trading in a range, maybe between 190 to 160, something like that, right? So we have this opportunity, this potential opportunity out there. And normally when I am working on the chart to plan iron condors, what I've been doing most of the time in most of the sessions is I've been looking at current price, find a collection of UFOs above, maybe draw a line here. Then the next thing I've done is to take a line, measure from current price to that place, how far is that, okay? Then I have taken that line and I have created a parallel, and then I have taken that parallel and bring it down to see how far this goes, and therefore I understood now this is my other UFO, and now I would draw a line here, okay? And I would say that the current price is equal distance between those two lines, and there are many UFOs between the lines, which are gonna really help for price to remain trading sideways for a while. May go up, may go down, may go up, may go down, but all those UFOs will create bounces and consume time, which is the ultimate goal of a non-directional trader. When you are doing non-directional trades, you are basically trading time. You are doing what could be called a theta play, if I was to use Greek terminology like we covered in the prior weekend. So so that's what it is, and this is normally what I do, and this is certainly a valid way on how to approach it, okay? Certainly 100% valid way on how to approach it. Actually, it's quite ideal in this scenario with MMM, okay? But at the same time, what I'm missing here is, you know, what if, let's go for the worst what if scenario. So the worst what if scenario is that the institutions cancel all their orders, okay? So let's say the institution cancel all their orders, and therefore it's like the chart looks like that. So if the chart looks like that, because the institutions cancel all their orders, well, now you have an unlimited amount of speed for price movement, because there is nothing to stop price. It all depends on how eager market participants would be, and you could certainly see the price of that stock to really skyrocket in the case of going up, or really start moving very fast down in the case of going down. But basically what is going to slow down that stock is the UFOs, and that's why the UFOs are giving us an edge, not only for the directional trading, but also for the non-directional. So I believe we know that. But again, what I'm missing is analyzing my worst case scenario. If I do an iron condor here, and what I do is, okay, let's buy calls above and sell calls below, Okay, the call side will be above the 189 line, and then below the 159 I'm gonna sell put, and below that I'm gonna buy put. Okay, so if I was to do that, which is absolutely fine, okay, I do have certainly a trade that makes sense. We have executed many trades like that since we started doing sessions in November last year. And I know that some of you are very, very happy because of the profits made, which means that this would work. Why? Because you have time decay working in your favor. You have the high price of the options identified by the scanner. Most importantly, the UFO slowing down the price, making this market to remain in its current condition, which is sideways or very slow moving stock. And next thing you know, you made a profit. Okay, but today what I would like to do is to take this concept, okay, and take it a little bit more advanced by also adding options analytics into the equation, okay? And as I was saying earlier, look at this area in here and, you know, play with this particular value and also the dates, and you will see the very, very nice effect that we can actually put together and construct, okay? So I'm going to show you that and you're going to love it, okay? So let me load MMM. And I'm going to move to the options tab first, okay, and that way we'll be able to see what's possible. Okay, let me see if I'm missing any question. Bojan, for some reason I have 57.14 in the RTH of MMM with 600. Oh, you know what? I know why that is, Bojan. I know why that is. I know why that is. And the reason why that is, it's because this is a brand new TradeStation that I just reinstalled, and therefore look at the amount of bars I am loading in this particular case. So what's the issue? The issue is that I have, I mean, it's not like I don't have enough statistics, but normally you have seen me use, and I'm pretty sure this is the parameter that you're using, Bojan, 1597. So if I'm loading more bars, I will have a greater statistical representation of the reality, and in this case it's 46%. Well, actually it's still pending data, so we still need to wait. But definitely, depending on the amount of data that you load, the statistical value will change, okay? And I didn't think of that when I was planning the trade, because normally I just use my predefined workspaces, okay? Look at that, okay? So if I load all this data, I am now with a little bit of a better number, okay? So again, this is what I just did is not critical, but we know that in order to measure stats, it's always good to have a large sample. So, you know, by default, you have seen that in many sessions before. By default, you probably remember that I use 1597. That's the number I normally use, which today I had it at 500 because this was a brand new instance of TradeStation that I just installed in this computer, okay? Good catch, my friend. Thanks for that. Teamwork, I love it. It seems for Iron Condors, 50% will be advantageous. Yes, for anything, Al, because remember, when we trade stocks with options, we are not even using stops. We are relying on multiple UFOs. We never rely on one UFO only because stocks are fragile. They depend on the index, they depend on the S&P, they depend on the Nasdaq, on the Dow Jones. So you can never rely on only one UFO. Okay, so 50% or above is great. And again, for non-directional, I'm just a little extra flexible. That's all. Orlando, 50-minute after, yeah, 55. Bojan, NVM, is it because I had 15 days of data loaded? Once I loaded more, the percentage went down. Yeah, you need to have a good amount of data, large sample. Yeah, perfect. Thanks for that. Good one. Very good one. So anyway, so let's continue. Okay, let's continue. Let me move this up. Okay, let's continue. So we are doing this trade, right? So let's go ahead and insert this trade now on the options tool, so you will see what I plan to do. So I'm gonna click MMM 12th of July. Of course, based on the plan I have on the screen, I would love to sell the 190s, isn't it? And if I sell the 190s, well, I don't have them on the screen, so I need to load a few more strikes. So if I do the 190s, I get paid nothing. Okay, well, 25 cents to be precise. So if I use the July 19, which happens to be the monthly expiration, I will enjoy more liquidity and more premium. So the 190, actually, funnily enough, and again, this is probably all half distorted because of the holiday. but it's quite funny how on July 90 the price of the options is 9, okay, where July 12 the price of the option is 50. Okay, so if you could buy at 9 and sell at 50, or buy at 10, sell at 25, that's an arbitrage opportunity. This is quite weird to see on the option chain, and I am attributing this to the fact that it's a holiday. Okay, so yeah, looking at the option chain actually is going to be quite difficult for me to be able to explain what I would like to explain, because on the call side, the put side looks more or less okay. Okay, well, you can see most of the strikes are looking okay, but the call side, you can see some strikes are totally distorted here. And again, this is this is real data coming from the exchange, but this is probably as a product of the fact that we just had a close prior to a holiday yesterday. Okay, so anyway, so what I was going to say, let's pretend for a minute, forget about the premium, but let's pretend that the 190s were going to be okay, and you were to analyze to do your iron condor. You would insert the iron condor in your simulation tool. Again, you have the 190, 192, and then on the put side, you will want to use the 160. So let's go for 160, and therefore I'll do 160 and 157 and a half. Okay, so I have the same thing above and below. Oh, sorry, not that one, the next one. Okay, so 160, 157 and a half below with the puts, 190, 192.5 above with the calls. In order to have you not to be confused, I'm just gonna type it so you understand better what I'm doing. So 192.5 is the one we buy, 190 is the one we sell, and then on the put side we have 160 is the one that we sell, and 157.5 is the one that we buy. So all those are $2.5 strike, $2.5 difference between those two strikes. Okay, so that would be your iron condor. And when you look at the risk profile, it looks like it normally looks. The big problem I have though is that notice how the blue line is below the zero line. Okay, so again, this is because of the distortion on the option chain, probably because of the holiday. So the blue line, which is the profit, is below zero. So that means that if you do this iron condor, you are guaranteed to lose. So obviously we're not going to do it. But again, bear with me on that because it's a little distorted because of that. We look at other stocks and hopefully we'll find it better later. But now what I also want to do is I would like to work a little bit with the price slices. And with TradeStation by default, the price slices here come as last minus 5% or plus 5%. But you can also work with standard deviations of price movement. Okay, so what is a 1 standard deviation of price movement? Okay, what is a 1 standard deviation of price movement to the downside? Minus 1 standard deviation. So if you use standard deviations, okay, notice how the bottom line and the top line, okay, 168.48 right here. Notice how they coincide with the gray rectangle. Okay, everything outside the gray rectangle is white. In other words, the gray rectangle represents that 1 standard deviation. You probably remember, that 1 standard deviation is 68%. Okay, so 1 standard deviation is what is likely to happen in 68% of the cases. In other words, 1 standard deviation is something likely to happen. So what is likely to happen here? So what is likely to happen, okay, and again, if you are an expert statistician, you may find funny how I just define a 1 standard deviation. I just want to keep it simple. Like for example, 2 standard deviation, I would call it something unlikely to happen, where 1 standard deviation is likely to happen. Okay, so again, it's not exactly like that, but I think it's good enough for this conversation. Okay, so what is likely to happen, which is a 1 standard deviation, from now until the expiration date. Notice the expiration date is July 19. July 19 is there. Okay, what is likely to happen is that from the current price, which is 174.97, the last price is 174.97. Okay, on the upper part of the chart, it simply looks vertical. So on what's likely to happen from now until July 20, sorry, let me say that again, from now until July 19, is that the current price, which is located right here now, okay, that stock may move up and it would be likely to reach the upper value of 188.71, which is the upper +1 standard deviation. It would also be likely to drop and reach, okay, the bottom standard deviation value, which is 168.48. This is the -1 standard deviation value, which is 168.48. So, in other words, what I have on the screen right now tell me what's likely to happen. Now, this is pure statistics. This has nothing to do with UFOs on the screen. This has nothing to do with which time frame are you looking at. This has nothing to do with any of that. This has only to do with comparing what may happen in the future out of utilizing past market data. Okay, past market data in this case is what is known in the world of trading options and non-directional trading, is what is known as historical volatility or simply volatility. Okay, take a look at this. I'm going to show you on the chart. So if on the chart I was to add a study, and the study I add is volatility standard deviation. Okay, volatility standard deviation is a measurement of speed that looks at the past data on the left. Let me change color so you can actually see it. So we'll make it purple. Okay, so this number, which is currently 0614, okay, 0614, let me translate what this means based on how this calculation is done. Okay, what this means is that, and by the way, to be what I'm about to say, and we need to switch to a daily time frame, and therefore instead of 06.4 it would be 01798. Okay, so what this means is that based on the speed at which the stock has been traveling in the past, no matter the UFOs, this is just pure statistics out of price movement, okay, it would be expected that 1 year from now, okay, this formula is always looking at 1 year from now, so it would be expected that 1 year from now, that stock is either up or down by 17%, 17.98%. That's what that number means, okay? Assuming that the stock remains moving at the same speed at which it has been moving in the past. Which again, it's not realistic, because depending on where the UFOs are, the speed of movement will change. If there are no UFOs, there is plenty of speed because there is nothing to stop the price. If there are many UFOs, then there will be low speed, because every time it gets to a UFO, it stops, bounces, go to the next UFO, stops, bounces. So basically, that volatility standard deviation is telling you what would happen to that stock, ignoring everything else, just based on what happened in the past. If the stock was to continue behaving the same way it has done in the past, 1 year from now, it will be either up or down by 0.17, let me say that again, it would be up or down by 17.98% in 1 year. This is what this calculation tells us. This is volatility, okay? So what the Option Station Pro is doing is that it's basically taking that calculation, and I need to show you exactly how I got it. So pay attention, because I need to show you a little bit of settings. And out of that calculation, instead of extrapolating that number for 1 year, that number is now the same number, but now pointing at the date of July 19, which is much less than 1 year. Okay, it's actually 15 days from now. So now you will be able to conclude that instead of 19%, it's going to be whatever percent. And whatever percent means that price would go from 174 to 181. Okay? That's what this means. Okay? That when you pick one standard deviation, basically this is what you have done. Okay? And I have summarized it and simplified it in this explanation, but I think it's a fair explanation for what these numbers represent. Okay? Now, we have the settings wheel on the upper right. Okay? Take a look. I am looking at, in the common area here, I am looking at historic volatility bars back. Okay, so how many bars on the left you're looking at? By default on the chart, okay, when you load this one, it's looking at 252 bars on the left, which is 1 year. Okay, 1 year. I want to, in the analysis I'm doing with the Option Station Pro, I don't want to look back 1 year, because 1 year is a long time ago. Stocks are dynamic and things may have happened 2 weeks ago to the stock because maybe a merger, and this has nothing to do with what happened 1 year ago, right? So therefore I'm using 89. This represents more or less 3 months, okay? Happens to be a fib number, which in case you have noticed, I always have a preference for those. But basically you can pick any number you want, but basically don't pick 1 year, it's too long. Okay, so this I'm picking up 1 quarter if you wish, doing that. Okay, and then very important when it comes to the pricing model, I am also using this Bergson and Stensland, which I did say that before. Okay, but what I didn't say in where is it here in option chains is that the expected move calculation, you have two, the optimistic and the pessimistic. So I picked the pessimistic. The pessimistic is gonna project a greater price movement, because the pessimistic is actually the one that does what I have explained using words. Okay, so make sure you have the same settings, and again you can review this video later on. It's gonna be posted on YouTube, isn't it? And you can review it and make sure your settings are equal. Okay, good. So when you do that, okay, and you select 1 standard deviation, okay, so this basically is telling you something normal. Okay, so something normal to happen, okay, something normal to happen. Okay, let me go back to 55. Okay, so back to 55. Okay, this is where we were. So something normal to happen, okay, would be that we reach 181.71. Okay, we reach 181.71. So let me do this. Okay, or 168.48. So 168.48. Okay, that would be normal. So we should expect this to happen. That would be normal. Let me change the style to dot. Okay. Style to dot. Okay, and something not normal to happen. Okay, something that would be too exaggerated. Okay, I want plus and I want minus. Okay, would be to reach 188 and 162. Okay, so 188 and 262. That would be a 2 standard deviation of price movement. Okay, so 188.71. And 162.23. 162.23. Okay, that is unlikely to happen. Okay, that is unlikely to happen just based on pure statistics. Okay, so this is like picture that you don't have the UFOs and you're just going with the stats. This is what it would be. Okay, that stock is likely to remain anywhere between those 2 horizontal lines from now until July 19, which is the expiration date. Okay, this is what's likely to happen. Okay, from today until July 19. So that stock is likely to remain in the purple box. Okay, going above the purple box is unlikely, but could happen. Surpassing the 188 would be very rare. Going below 168 could happen. It's not too likely, but could happen. Now, surpassing 162 would be very rare. Okay, so now this is what probabilities tells us. So if probability tells us this without the UFOs, okay, in other words, this is something that everybody could know. Okay, everybody could know that just because it's just probability calculations. It's given to you by the computer. People don't even know your on-field orders exist, and they would be able to find those values of 188, 181, 168, 162. So therefore, imagine if you are trying to sell the 160, I mean, how unlikely that option is. That option is very, 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 very unlikely to become in the money and hurt you. It's very unlikely. It doesn't mean it's not going to happen, but based on pure probabilities, it's very unlikely. So if that's the case, how much are you going to get paid? Okay, and probably it's going to be nothing. Okay, because you can see here, if I go to options, you look at the 160, you get paid 16 cents. So why do you get paid so little? Because that option is so unlikely, right? So unlikely. So yeah, you could certainly sell it, but you will get paid nothing. Why? Because basically you are taking no risk or extremely low risk, and therefore you are gonna get paid extremely little. So in options, okay, normally it would always be better. Well, in options, or I should say in trading in general, it would always be better to be open to take some risk. Because if you don't take some risk, you will get no reward. So instead of looking at the trade like, oh, I don't want to risk anything, maybe it would be better to be open to risk a little more in exchange for a much better balanced trade, because this is all based on probabilities. So let me show you. So if instead of doing 192.5, 190, let's say I was to do 182.5, and then I do 185, okay, and then I was to do 167.5, and then I was to do 165, okay. You know what? I am taking more risk because now the options I sell are closer to price. It's 182 and 167 instead of 190 and 160. So now I'm taking more risk. But based on probabilities, simply based on probabilities, this area up here and this area down there, even though it's a possible area, it is a not so likely area, because the likely area is the one in the middle. That's the likely one. The ones above and below are unlikely, and the ones below are very unlikely, and the ones above are super very unlikely. Is that making sense? But the ones where I have my dot right here and right here, those two areas are not crazy. So if you were to sell options in between, I would say that's too risky. But if you sell options beyond the dotted line, in other words, beyond the 1 standard deviation, then it's not that crazy. And here is our edge, which people don't know that. Okay, when you activate the UFOs, now you get to understand what you have. And now you can modulate in a way that is more precise. How do you want to structure the trade? So before I finalize planning this trade, let me take a look at your questions, and also please confirm to me if you are following or not, because this is an important thing. Okay, so please let me know if you are with me or you're not. Let me see. Lisa, you are a Sigma Master Black Belt. Amazing. Yeah, I was really oversimplifying, but I think it's good enough. Okay, so Orlando, Jose, can we run this Aaron Condor in the search tab and see the stats there, similar to how? No, we cannot do it. We will need special code for that, and certainly we can develop that, but it's not anything standard in TradeStation. Standard deviations in Tesla are completely dependent on Elon's tweets. Yeah, definitely, and the fact that orders are added to the market and orders are cancelled from the market too, because certain markets are very, very, very prone to react to the news, and other markets are much more stable stocks, if you wish, that are less influenceable because of the news. Okay, so definitely. Jose, how did you get now in the column labeled plot? How did I get now in the column labeled plot? So in analysis, so it's the way it is. If I select, whatever I select, in the graph settings, okay, I decide what I want that the gray value to be. So I decide that. Okay, so if I pick expression plus 1 day. So this basically is telling me the now, okay, which is 15 days to expiration. If you don't see now, probably it's because you're using a different version of TradeStation or a different build. But the range expands with time passing, so you do not use expiration date to determine the range. Well, again, Lisa, I'm halfway into the process, and I get your point, and I agree with you. But I'm halfway into the process, and what I'm trying to do is to have references as you begin planning the trade. But certainly, what I would never do, and please listen carefully to this, because Lisa is 100% right, what I would never, ever, ever do, it's without the UFOs on the screen, just because of those statistical values, go ahead and sell the 182 just because, you know, it's above 181, and 181 happens to show on my Option Station Pro in that portion right now, okay? Well, right now it's 2 standard deviations, okay? So, you know, I will need to make it 1, okay? So +1 and -1. So you never want to do trade just because of stats, because everything is variable. Stats depend on what happened in the past, and what happened in the past depends on the time, on the speed of movement, it depends on many things. So all those ranges are not going to stay static like that for us. That would be great. It's not the case. Everything will be dynamic. So that's why it's so important. Now that you understand the meaning of the information available on the screen, it's very important to add the UFOs, because the UFOs is the reality of that market, okay? So now what I could do, okay, now is to come here and say, okay, because this area here, okay, above 181.71 is the non-crazy area, okay, and I have a UFO there, okay, that UFO at 183 will set the calls I sell, okay? And now you would go check what calls are available around 183. Okay, and the available is 182.5 is the nearest one. Okay, that one pays you 24, so then we would take that one. Okay, so you would sell. Funnily enough, I got it right. So 182.5, 185. This is what you would sell. Then you would look at where this line is. Okay, and this line is telling you that you know, beyond that line is not likely. Okay, so what do you have beyond that line? You have that green UFO right here, right, and that one is 166. Okay, 166. So you will want to sell the 166. That's what you will want to sell. Actually, funnily here, I just wrote 167.6. That doesn't exist. So let's see what we have. 166, we don't have it. We have the 167.5 or the 165. Okay, so that's what you have. So you know, that's going to be a tough call. We need to simulate to see which one is most ideal. Probably 167.5 would be the one ideal once you do the simulation. Okay, and now you will come up with deciding these are the strikes I'm going to use for the trade. Why? Because they are both beyond the unlikely line. Okay, beyond this line is unlikely. It's possible, but it's unlikely. Okay, and most importantly, you had multiple UFOs to defend yourself, and on top of that, you have an extra final UFO as the final defense. Okay, and on the upper part, same story. You have this UFO to defend yourself, and most importantly, beyond the unlikely line, you have that final UFO to defend yourself. So this, okay, based on July 19, okay, this would be the result, and this would be the Iron Condor that you would want to plan, and then this Iron Condor may work or may not work based on the rules that we have when it comes to let me show you the rules so it's crystal clear in your mind. So let me load the Word document. Let me see. Here we go. Okay, the rules that we have are rules that are asking us to collect, you know, at least 15%. We want the credit to be at least 15% of the difference between strikes. So in this case, the difference between strikes is calculator. So the difference between strikes is 2.5, right? So 15% of that is 37.5. So the question is, if I do 185, 182, 167, 165, how much do I get paid? Well, if you add this in your simulation, so we said 185, 182.5, so 185. 182.5, and then on the bottom part we are doing 167.5, 165. So if you're doing this, the premium that you would collect, okay, let me add a couple of things here. So I want to customize columns, I want to add the bid, I want to add the mid, I want to add the ask, and I'll move that up. Here we go. So how much do you get? You would get 32. And what is the rule suggesting? The rule is telling you, for you to be able to take this trade, you need to collect at least 37.5. So we have a problem. This trade will not be valid. And it will not be valid because it doesn't meet our rule, which is protecting us. Okay, if options were a little extra overpriced, okay, and again I told you what happens right before holidays, okay, and normally options shrink. If we had done this yesterday, maybe it would have worked, okay, but today is not. So you know, other days you will have that rule met. And now what are you doing? So now you are basically doing the Condor, and you know which strikes to use instead of randomly go ahead and, you know, let's try below this UFO, and you know what, the equal distance is that one, so let's try that one. So instead of just going like trying to spot it visually and see how you feel, again, moving away from subjectivity, adding objectivity into the analysis, you would use Option Session Pro, okay, on how to do that, okay? Could you guys please confirm that you understand what I have been exposing you to, guys? Yeah, Interactive Brokers offers that feature. I agree with you, it's very useful, Orlando, but IB ignores the most important part of all of it, which is the UFOs, okay? So, you know, I mean, if you guys are open, you know, you know, I guess it's not a priority or urgency, but we can certainly work on developing tools to do this analysis automatically, you know, because obviously technology is available to do it, okay? So we can create a scanner on TradeStation that looks for the right location, the right strikes, the right UFOs, and simulate the whole thing, right? And tell you if the trade is valid or not. So that way, no wasted time. Perfect. Okay, so now here's an exercise, because this trade will not work. We just concluded that. So the next question is, okay, what if instead of doing this trade using July 19, we were to use July 12? Okay, notice the moment I change July 12 here below, notice what happened above. July 12 has changed. Yes, I understand, Orlando. Of course, I know you do. And if you do, it's going to be very powerful, okay? I was just saying to have the whole scan automated, including the UFOs. That's what I was saying, okay? But yeah, I know you're doing that, my friend. So anyway, so July 12 is now up here. So what happens now? Well, the new standard deviations are different. Why? Because now you have less time. So at whatever speed that stock is moving, the price movement that is possible will be less. Okay, it will be less. So if you were to redo the same type of analysis, okay, and in this case, I'm not going to plot the 2 standard deviation. I'm just going to go with the one standard deviation. Yeah, Bojan, you read my mind. That's exactly what I meant. So 178.87. So let's go ahead and add a couple of lines. So 178.87 will be the first one. Okay, so 178.87. And the second one would be 171.15. Okay, so now you know what is likely to happen from now to July 12. Okay, so from now to July 12, so here's July 12. So that stock is likely to move within that box. Okay, that's what's likely to happen based on pure probabilities, ignoring everything else. Okay, so that's a good reference, because now if I have UFOs above or below, that's it. That is how I'm gonna set my strikes. So below, I mean, it's quite clear, isn't it? So instead of here, I will just use that one. That would be the one. Now above it's very, very limit. Okay, so what I'm gonna do, because earlier I didn't do it properly as well, I want to look at pre and post market. Okay, with regular session we got 49%, with pre and post we got 46. Okay, so it's not helping. Okay, but since earlier I got the wrong amount of candles on the chart, so I wanted to check. Okay, so what would you do? Okay, well, you would go for this trade using the 179, and in this case using the 169 something. Okay, and that would be the range that you would trade with an iron condor. So let's redo it. Okay, so we would have here we would have an iron condor made of buying the 180 call if that was to be available, selling the 179 call if that was available. I'll see the option chain in a minute. Selling the 169 put and buying the 168 put. Okay, if this was possible, it would be great. Now, possible depends on the option chain. So let's check the option chain. So July 12, I don't think we'll have 69s. No, we don't have 69s. We have 70s and 67s and a half. So 70s, let me assess 70. 70, I guess is fine because it's 169 something. So we can do 70, and 70 pays you 34, so that's okay. 70 is 167.5. So this could be the case. 170 and 167.5. Okay, 170 and 167.5. So let me add this on the put side. 170, 167.5. And then on the call side, 179 is the target. So let's see what we have. We don't have 179, we have 180. Okay, and unfortunately this one doesn't meet the rule because it only pays 20. The super minimum is 25, and we are not meeting the rule. Okay, so I will pretend that we do, just so I complete the example, so you understand the whole process. So it would be 180, 180, and 182.5. That would be the process. Okay, and this would be the setup that you will be using. Okay, so notice that beyond the likely line, if you wish, you have a little bit of room for movement still. You know, that particular square here and here, those two areas on the chart happen to be above the zero line, which means that this is the profit you would get. Okay, this is the size of the profit you will get. Okay, even if the stock goes above 178, even if the stock goes below 171, okay, by this amount. Okay, so this is the little bit of a wiggle room that we got. Okay, shooting for slightly beyond the likely area. And again, the reason why we do that is because we got UFOs to defend ourselves. Now, one more comment. Okay, and please confirm to me in the chat box that you are with me on everything I just said. And now that I have redone the example for July 12, please confirm to me that you followed and everything makes sense on your side. Okay, but I want to add one more thing while you are typing. Okay, and if you have to type yes, just to confirm yes, I would love that you say yes. Please don't stay quiet. I would love to get your feedback if you don't mind. So now, something important to also know is that obviously this would be a more aggressive iron condor compared to most of the iron condors that I have planned for you before in this session. Because in the prior examples that we have done together, I certainly used a lot of my experience when looking at the chart and many iron condors that I have planned and executed in the past, and therefore somehow I was processing subconscious math in order to spot the right UFOs for certain trades. But I have to say that I've always been in the conservative side. When in doubt, I just went for the next UFO. This is what I've done all the time in prior sessions when we have been here together. And therefore, you guys have experienced great level of consistency on those condors. Now, if I narrow them a little bit, okay, you will experience a few more of the Aaron condors not working well, okay? Because even though we added probabilities, even though we added UFOs, well, probabilities are just probabilities. As Lisa said, everything is moving. Second, UFOs are UFOs. That's true, but remember, stocks are fragile. So, the bottom line, the closer the lines, the more likely you will fail. The wider the lines, the more likely you will not, right? But again, the wider the lines, the less you get paid. So it makes no sense. And the closer the lines, the more you get paid. So it's more juicy, but it's more risky. Okay, so you have to kind of find the sweet spot, and this is one way on how to find the sweet spot, which is objective, okay, with no subjectivity. But again, the lines are narrower than before, so you will have a few more stop outs. Okay, so what we need to cover, is the damage control mode, okay, which is something that we'll do in a sharpening session, because obviously I surpass the top of the hour by 15 minutes, so we need to conclude the session here. But what we will need to do is to cover damage control, because if the stock stays in between from now until July 12, congratulations, you made all the profit, done. Okay, but the question is, what if the stock surpasses? Well, if the stock surpasses, two things may happen: surpasses and keeps going crazy, or surpasses and then comes back in. Right? So if it surpasses and comes back in, you know what? It's fine. You still made your profit. But what if it keeps going? Well, if it keeps going, it's fine too, because you're gonna get your loss, which you know what it is before you start. So it's also okay. Okay. But at the same time, if we were to add damage control mode and we were to kind of recreate a zone for profitability, okay, because you still have UFOs, isn't it? And if price goes up all the way, I'm pretty sure you expert UFO traders, you know that you would have also UFOs below, isn't it? So then it would make sense to move into damage control, to restructure the whole thing based on a different setup, to attempt to end up with a small profit instead of a loss, and certainly diminish the size of the loss. And instead of taking the whole loss that you were happy with, which is okay, make this less. That would be objective number one. But objective number two, which is idealistic and not always achievable, but it would be to hopefully end up with a small profit instead of a small loss. That would be the idea. And we'll talk about this damage control mode in a different session, because obviously we'll need more time for that, okay? But anyway, just as an extra reinforcement of what we did today, which is quite important, because tomorrow you can spend the whole day practicing this, isn't it? So I would like to go back to UNH, okay? And notice how fast this is gonna be. So you load UNH, okay? Statistics with UNH are looking better now, because I have more data on my chart. I should have thought about that before. So let's wait for the pending data, and that way we will know much better. Iron Condor with Jose's concepts tools become titanium condors. Another masterpiece drawing by Jose. Oh, you guys are funny. I love your humor, guys. Lisa, you are very funny as well. Very good. So we got 51% now with the UNH, okay? So that's much more comforting. What about the pre-post market? So instead of 51, it becomes 1, 2, 3. Pre-post market. Okay, so TradeStation is waiting for data. Here we got 45. Okay, so in the case of UNH, we will discard pre and post market and we'll rely on regular session only, and that would be 51%, which is this is good enough, isn't it? So what do we have? We have UFOs above and below, same story, correct? But now statistics. Remember, that stock was reporting earnings on July 18. So for that stock, we cannot surpass, with UNH, we cannot surpass July 12. Okay, so let's randomly pick any iron condor, sell iron condor, right? So I can come in here and change minus 5% to plus 1 standard deviation and minus 1 standard deviation to see what that number is. And now I know that from now until July 12, okay, the likely line would be 238, 252. So let's draw those lines on the chart. So 252 is somewhere in here, okay, and 238 is somewhere in here, okay. So what am I gonna do? I guess it's pretty clear. I will want to sell options here, and I would want to sell options here. That's simple, okay. Look how simple this becomes by doing this, okay. And not only simple, you are stacking another little edge in your favor, which is some measurement of probabilities. Now you want to buy a call, you want to sell a call, okay, and then you want to sell a put, and then you want to buy a put, okay. So 253 is what you're shooting for. Let's see what's available. We have 252.5, we have that one. We also have 255, pays you 33. So I'm gonna go for a 255. So 255 and 257.5. Okay, those will be valid. Okay, so 255, 257.5. Okay, and on the put side, we are looking at 236. So don't think I'll have the 236, but probably the 235. Yes, the 235 is paying 46. That is good. Okay, it's giving us what we want. So 235, 232.5. Okay, so we have it, and adding it now in the analysis tab, 235, 232.5. And now that I have it, so let's see what we got. Okay, I have $2.5 of risk, isn't it? So I'm looking, is exactly the same case as before, right? So I got $2.5 of risk. So I'm looking at 15% of that, that is 37.5. And notice how, again, this, I'm telling you, this is the holiday effect. We are getting 32. So the trade would not be valid. Okay, but again, how long it took me to plan that iron condor? Okay, how long it took? Took nothing. And most importantly, the location for those lines is not based on how I feel today. It's based on stats, which yes, they would be changing through time, but at least I got an objective reference to start with that points at the key UFOs for this particular trade that are likely to have this market remain range bound. Okay? Anyway, so hopefully this was useful, guys. So we still need to take this to the next level. We need to do the damage control, which is also very important. Okay, but today I think that we had a pretty important step forward when it comes to building the condors, because we never had this conversation before, and hopefully that was useful. Okay, so guys, pleasure to join you, and you guys showing a major passion for the markets on July 4. I know many of you are in the US, and not everybody, but many of you, and joining us today in a holiday, it says a lot about you. Okay, so good job, keep it up, and as well as the discipline and everything you are doing, guys. Okay, wonderful. Take care, my friends. See you soon. See you over the weekend in the sharpening session. Enjoy 4th of July, guys. Take care. Bye-bye, everyone.